Diversification is one of the most important concepts that relates to saving and investing. And diversification, in simple terms, is not putting all of one's eggs in one basket. And what it means, basically, is investing in, when one makes investments, among different assets and different securities that don't move perfectly together. And what can be shown mathematically is that when different investments don't move perfectly together, that we can get a similar return with a lower level of risk, or a better level of return for a similar level of risk, which means basically that one can have less risk and get the same return by diversifying among different assets. Diversification can take place at numerous levels. Obviously, it doesn't make sense to put all of a portfolio into one stock, so one can diversify between different stocks. But there are also things that affect all stocks at the same time. For example, the economy can affect many stocks, the cost of capital can affect many stocks, and very importantly, if all stocks are being sold by major institutional investors, or equities in general are affected by certain major events, then those stocks will tend to move more together, and there is a reason to diversify beyond just two stocks. So diversification can take place at the stock level, and clearly makes sense at the stock level to own multiple stocks, and many argue that index funds are a great way of achieving that because it allows one to get exposure to an overall index with one simple transaction effectively. But even going beyond that, we can talk about diversification between stocks, bonds, commodities, real estate, and other asset classes. And the idea being that we're aiming to have investments that don't move perfectly together, and where we have a very reasonable expectation and informed opinion regarding the fact that they'll go up over time, but we're not exposed to something going wrong within one of those areas for our entire outcome. Now, diversification ideally takes into account two things, and when we talk about diversification, one of the things that's most commonly talked about is correlations. And correlations, when they're calculated, are always based on historical data, meaning that the correlation between any two stocks, when it's calculated, can only take into account what we know about the past. And the correlation going forward can be somewhat different for two reasons. One, because those companies may end up doing similar things or being exposed to similar markets more so than they were in the past. But even more importantly, perhaps, is that if the two companies are owned by comparable shareholders, then if those shareholders decide to sell, then they'll sell both companies, affecting both of the share prices at the same time. Meaning that companies that may not have anything to do with each other, or even asset classes that might not have anything to do with each other from a fundamental perspective, might become very correlated, particularly at times when major sales of these asset classes are taking place. So if there is a shift out of equities into something else, then stocks that one might have thought have nothing to do with each other end up moving very much in a similar way. And that is most commonly seen in times of extreme stress in stock markets, when all stocks are being sold at the same time, or many stocks are being sold at the same time, and these historical correlations, which may have been much lower in the past, end up becoming much, much higher at a time when we need the correlations to actually be different more so than ever, because we are relying on diversification to provide us with some benefits, and so that not everything is going down at the same time. So when things really go badly, they actually go even more badly, in the sense that the diversification benefits tend to go down and even almost disappear across an entire stock market. So diversification relates to owning assets that ideally don't move perfectly together, where we have over the near term, i.e. one might go up and one might go down over the near term, but over the long term, over the period that we aim to hold them for, we have a very good and informed opinion as to the fact that we think that they will appreciate over time and deliver a return. And secondly, it means taking into consideration also the owners of those assets, and taking into account the correlations can increase at times based not on fundamentals, but based on the owners of those assets. And for example, real estate and stocks may not have that many things in common looking forward at a very stable and in a benign economic environment. But if stock markets tend to if the stock market has a very negative move, then that can affect real estate, particularly in markets, for example, where a large part of the population works in the financial services industry and is affected by these stock market moves. So diversification is very much related to not putting one's eggs in one basket, and spreading assets among different asset classes where we have a very reasonable expectations that the asset will appreciate over the long term. They don't move perfectly together in the near term, and where they will not be sold all at the same time by the same owners. Not putting